This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness. With the people, products, and technology to take you there, it's why they say, at PennyMac, greatness lives here.
Welcome to The Interest, your daily dose of the news that matters. I'm Mike Savino, and these are your headlines for today, May 23rd. Lenders raked in the cash as rates sat at historic lows over the last 2 years, but now the market is tightening. Refis are down, and leads are also starting to dry up. So how do lenders adjust to this new reality? Our own Christine Stewart got some helpful tips from an expert.
If you're relying on leads, when the market begins to contract, as it is right now, the leads get very expensive.
That means the average cost per loan was around $500 in 2021. Year to date, that number has jumped to $1,500 per loan.
You've tacked $1,000 onto your expense per loan, and your volume has dropped significantly.
So how do they compete?
You really got to focus on training people, because too often the CD lenders do not realize how critical it is to train people how to handle a purchase, which is very different.
But almost every company has announced layoffs or voluntary buyouts.
There were 300,000 people in the mortgage industry before rates started falling during COVID. There's 440,000 at the end of last year.
That means if things return to pre-pandemic levels, 140,000 people will no longer be in the industry. What about mergers and acquisitions? In 2018, there were 33 transactions. Graham predicts that number will get to 40 or 50 by the end of this year.
It's absolutely blistering.
Most of this M&A activity is happening with independent retail mortgage bankers.
You're going to have to invest to grow market share.
For the Mortgage News Network, I'm Christine Stewart.
And refis aren't likely to rebound anytime soon, as rates for fixed mortgages have hit a 13-year high. The rate for a 15-year fixed mortgage was 3.16% at the start of the pandemic and fell to 2.29% a year ago, but now it's up over 4.5% according to Fannie Mae. And the 30-year fixed rate has followed a similar path from 3.72% in early 2020 down to 3% a year ago before climbing back up to 5.27%. The rate hikes come as home prices also remain at record highs, and the CEO for Money Transfer says that combination is likely scaring away some buyers. Large monthly payments threaten to price out buyers that can't put down significant down payments. That's happening in the backdrop of escalating rents nationally, exacerbating the difficulty of first-time homeownership. And we're seeing that play out in the market. Home sale prices continue to climb, but Redfin says completed and pending sales are both down from 2021. We saw just 570,000 sales and 515,000 pending sales last month. Both of those numbers are down more than 7% from last year. But sale prices are up 15% year to year because inventory remains down. The 1.4 million homes listed for sale is a drop of 9%. That dip in inventory is what's keeping prices high, but an economist for Redfin says that a dip in demand will eventually bring prices back down too. As demand continues to soften, more sellers will likely be forced to drop their prices in order to get offers. The good news is that this should finally bring more balance to the market. And finally, consumer confidence continues to weaken. Americans are becoming more pessimistic about finding affordable housing in the next year. That's according to the Federal Reserve Bank of New York. Its April survey shows that people don't expect housing assistance or affordable housing to ease up over the next 12 months. In fact, their feelings about affordability declined to 37%, down from a peak of 52% in August.
This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness.
For more on these and all of today's top stories, go to mortgagenewsnetwork.com.